there's going to be a lot of more terminology. So I'm going to go through the processes of describing what these mean. There's going to be a lot of what these mean, but also how we can understand the terminology. The biggest piece we want to make sure we take away from the trainings moving forward is this is I'd say 70% of this exam is terminology. As we continue to grow through this course, you're going to realize that as you start studying this material on your own, you're going to start to see terminology kind of intertwine itself, and you'll see things that like, oh man, that question reminds me of this question. And chapter 3 is we're going to give you the skeleton of all the things that you're going to need. We're going to go ahead and get started now. It's already 8 o'clock, so everyone else can join us as they get started. Let me just share my screen here. Okay. So if you are again with us, I appreciate you guys having your cameras on tonight. Again, be in a position to where you can focus. Obviously, add input. If you have questions, put them in the chat, and I'll make sure I try to answer those throughout tonight. You will see a part where there is a lot of writing down. There's going to be some things you're going to write down tonight, Anna, and I want to make sure that we give you these nuggets. So, we left off last night on chapter 2 on annuities, right? I'm going to cover the part of annuities towards the end of this chapter, meaning the part of how do you actually get the money? How do you receive the money, right? And there's a few acronyms we're going to go into. But let's talk about chapter 3. Chapter 3 focuses on life insurance policies, provisions, options, and exclusions. Gia, all these are just going to talk about what are the owner of the policy, what options do they have to do with the policy? Why would the policy not pay out? Can you add multiple families onto one policy? What happens if this situation happens in an insurance policy? We're going to cover a lot of that tonight, okay? So as we jump into this, we're going to talk about some of the terminology we're going to look at. So first one is, let's see, activities of daily living. A person's essential activities that include bathing, dressing, eating, or transferring, toileting. That one's I don't know. I've actually haven't seen that one in a while. I'm pretty sure that'll come up in the disability part of insurance. One you do want to know, Anna, is assignment. The word assignment means transfer of ownership. So, Misty, that means you are going to legally sign your policy over to somebody else. So, transfer of policy ownership. So that's when you give the policy's benefit, the ownership of it to somebody else. The second definition, Gio, we're going to go through is consideration. Consideration, something of value that each party gives to the other. And we talked about consideration in chapter 1, which was part of the 4 legal binding pieces to make a contract legal. If you guys remember that. So remember, consideration is just something of value that is given. And the case of a policy owner, it is the application that they propose for the insured and their premium. That is the value that the policy owner brings. The value that the insurance company brings is they promise to pay the death benefit. Okay, the word indemnity. It's a principle of reimbursement in which insurance is based on. In the event of loss, an insurer reimburses the insured as a beneficiary as of loss. So we're going to cover indemnity a little bit deeper, so don't worry about that too much right now. Lump sum. We talked about that one pretty deep. Anytime you see the word single payment, single premium, the word lump sum. Where you're going to see lump sum come in this chapter is when the benefits are paid out to somebody. So you've seen us talk about paying into a policy in a lump sum. Tonight, you're going to hear about getting paid out in a lump sum, either from a policy or an annuity. A minor, a person of under legal age. For the sake of the exam, a minor is someone that is 18 or that is younger than 18 years old. There are some insurance policies that it will cover a child until they're 25. But for the sake of the exam, the policies that which they call child riders would generally only take them to their 18 or 21 years old. Just a rule of thumb we're going to talk about, okay? The NAIC, this is the National Association of Insurance Commissions. We'll cover that more in detail. The word principal, this is the original face amount. This is the face value of the policy, the original amount invested before earnings. We'll cover that a little bit more in detail on annuities as that jumps in here, right? Okay. So we are gone through those terminologies. If you have any questions, please feel free to put them in the chat. I'll answer them as we go. The first part we're going to start with is provisions. Another word for provisions is rights and obligations. These are what the obligation of the insurance company and obligation of the policy owner. So in this scenario, the first terminology we're going to go through is the entire contract. When you write a policy and you deliver it, let's just say you have a physical copy, Gia, you would deliver the policy. It comes in an envelope. And in the policy, you'll have on the front of the policy, you'll have the policy summary. You'll have the policy itself, and the back of the policy, you'll have a copy of the actual application of the original information that was written on the application, and then any writers, okay? So when you are writing this down, this is what you want to write down. You'll see a question. It says, all of the following are in the entire contract, except if we know that the entire contract is nothing more than just the policy itself, the original application, plus any writers, which are add-ons, and amendments, which are, hey, something came back, we just need you to acknowledge what we found. There are certain times when you will write a policy and the person gets rated. Remember, rated is someone that's going to pay a higher premium. And it says, your quote is no longer what we thought it was. We have a new amendment, which says your new premium's this. So you'll have to get that signed. So you want to write this down. This is the only definition you need to know when it comes to entire contract. You're going to see questions that when we go through the multiple choice, you'll be like, oh, this is in that entire contract. Let me memorize what that means. This one right here, the insuring clause. The insuring clause is a basic agreement between the insurer and the insured that states that the insurer promises to pay the death benefit. This right here is what you need to write. Their insuring clause is that the insurance company promises to pay the death benefit upon the insured's death. Okay. So insuring clause is that the insurance company promises to pay the death benefit upon the insured's death. This one right here is an easy one to get right. The free look provision. I want you to write 14 days next to that. If you are in a different state other than Florida, yours might be 10 days. You need to make sure you go back to your chapters and look that up individually. But I think most of us are in Florida today. Free look provision is 14 days. That simply says that after the policy is delivered, the policy owner has 14 days to look at the policy. And if they say, hey, listen, I don't want it anymore, they can return it and get a full refund. So free look provision starts on the day of delivery. Make sure we have that noted. What is delivery? It can be electronic, it can be mailed, or it can be physically delivered. All those count as delivery. If you get a policy physically delivered, you have what is called a delivery receipt that you will get. From that date it's signed is when the policy is that free look provision goes into effect. I think that's just an easy one to get right. Okay, consideration. Consideration is when, again, both people bring something of value to the policy. I just kind of stated this again. Consideration is the client, the policy owner, they bring their application and their premium to the table. That's the value they're bringing to the insurance company. The insurance company, their value is that if God forbid something happens, they are going to pay out the death claim. So they both bring something of value. Okay, this is a big one right here. We want to know this. Ownership rights. What does the owner have the right to do? Remember, the person paying for the policy is the owner. If someone has a policy and the insured does not like it, I heard that the insured can attest something, but I don't know how legal that is. I don't know that answer. But for the sake of the exam, we don't need to know that. We just need to know, Nisha, how does the owner have rights of the policies? So the policy owner can change they are in control of the payments, they control the beneficiary, they can sell the policy if they wanted to. They can do everything. They can cancel it if they want. Pretty simple. But I want to go into something called assignments, and there's two assignments we're going to go through. The word assignment is just meaning you are assigning the ownership of your policy to somebody else. So there's two ways that you would change ownership in an assignment. The first one is absolute assignment, and this right here is what you want to write. You're transferring all rights of ownership to a person or entity, and this is the permanent option. So given later in the chapter, you're going to see something called terminal illness riders, where you can actually sell your policy to somebody else if they wanted to buy it from you. So when you do absolute, think it's all rights are sold. It's permanent. The moment you do that, you sold your policy. So absolute assignment is transferring all rights. The policy owner does not have to have insurable interest on the insured. So the person you're selling this to does not have to have an insurable interest in this situation. Because again, when does insurable interest have to occur? Yeah, I see it. You said it right there, right at the time of the application. That's reading your lips. Good job. All right. Collateral assignment. This is when you transfer a partial rights. Next to the word collateral, I want you to write the word temporary assignment. And then I want you to write the word debt next to that. I'll give you an example. If you do any type of applications, sometimes people, if you do like a loan transaction, people always ask you, well, do you have any collateral? Do you have any life insurance? If you have a whole life policy that has some cash value built up, sometimes you can use that as collateral if you have any money in there. Can't do that with a term policy. Okay. So that would be partial tides. I've never seen this done, but that is how on the exam, just collateral assignment is temporary. It's not something you do for a long time. Any questions on that? Nope. Okay. Am I good to move on? Try to give me a thumbs up. All right. Okay. Okay. Let's talk about beneficiary designations. So the beneficiary can be anybody. You can name the beneficiary to be your dog or your cat. You can make it to be anybody you want. The things that we have to look out for is this. Beneficiaries to a minor. That minor cannot get the money until they're 18. So if you have your kids as your beneficiary, I would encourage you to have somebody else there with it, because that money can get tied up in the courts. And it says, if it's beneficiaries designated to a minor, the minor's guardian can be paid to a trustee of the minor if the trust is named in the beneficiary or paid directly by a court. So you can't just say, hey, I want my 4-year-old to get this money. That money gonna sit there for what is that, 12 years if something happens. The important piece about beneficiaries is that if God forbid something happens to you, a creditor cannot come after your beneficiaries for that money. Sometimes you'll have that. But I will give an example. Has anybody ever here heard of a family co-signing for student loans? This is an easy way to help families get policies. If a parent has be a co-signer for a child's student loans, they need to have insurance on that child. Because if they co-signed, that family's still going to inherit that debt. So life insurance can be a way to pay off that debt. We know the government's going to get their money. I don't care if it was Trump or Biden, they were coming after you to get your money. They're going to get that money. If you're an Android user, they're definitely coming after you. Yeah, I know. I just had to drop it in there just one time, right? All right. All right. So I share that with you because later in the chapter, and again, I'm probably getting ahead of myself. I just want to summarize this for you. If you name your child on a beneficiary on an application, sometimes it'll say all children equally. If you do not name those children, if you don't name those children individually and you have a stepchild in there, guess who's getting left out? It's only going to go to those individuals that are blood related or that the court can actually make out to. So you want to be as specific as possible when it comes to making beneficiaries. Another thing is, if you have a trust, if you have a business, you can make the trust the beneficiary of your policy. And the person that is over the trust will designate how those funds go. So I think that's pretty important as when we're talking to clients is, hey, if God forbid something happened to you, what happens to your children? And they say, well, I don't know who my kids are going to go to. Well, we should probably think about that. And you start diving into those deeper conversations. So let me go through this part right here. So when naming beneficiaries, it is most prudent to be specific by naming each individual or designation by exact amount given to the individual. So there's 2 class designations are available for use. So when an insurer chooses group beneficiaries, which is called per capita or per, I don't know that word, stripes. I don't even know how to say that word, you know. But by meaning by the head, which evenly distributes benefits among the living named beneficiaries. Per stripes or whatever that word, meaning the bloodline. I just had a client today talk to me. He said, hey, my mom passed away and she named us as the beneficiaries, but she actually wasn't my mom. She was my aunt, but she was my mom. And they had to go through a whole court process to get named as the beneficiary. They had to show proof that she took care of them.
Yep.
So in this scenario, we have to be a fiduciary to do the right thing by our clients and letting them know, hey, this is what happens. We can't rush through this part of the application, right? So, give an example. So Brian purchased a $90,000 policy. He named his three sons, Quentin, Stephen, Patrick, as beneficiaries for equal shares. Quentin has two kids of his own, Bob and Lou. Stephen and Patrick are both married, but unfortunately have no children. Unfortunately, Quentin predeceases Brian. So now the father that had two kids happens here, right? So if Brian selected per capita designation, which is by head, Quentin's gone, only naming two beneficiaries, and Stephen Patrick would get $45,000 each divided by two. Quentin's two children would not receive any of the benefits since they were not named as the beneficiaries. So now it just went to the two kids. His grandchildren, nothing. If Brian selected per stripes designation by bloodline, Stephen Patrick would receive 30,000 each, and Quentin's kids would receive 15,000 each. Does that make sense? You're not going to see a lot of that on the exam, but it's good for you to have that in your mind as an agent. Okay. A big part of it being a beneficiary is two things. There's three types of beneficiaries, numerical. The first one is primary, that if God forbid someone passes away, this one's getting the money. And generally it's the spouse, right? So if husband and wife both have a policy on each other, husband passes, wife gets the money, right? Now you can have what is called a contingent beneficiary, also known as a secondary. This would pay out if the primary died prior to the insured dying. So husband and wife, married, wife dies before the husband. And let's just say the contingent are the kids. The kids would be the second one in line to get the money. That makes sense?
Miguel,
Yes.
before you move on, I apologize for my lateness, everybody. I want to elaborate on this because my grandfather on my mom's side, he has tons of property in Georgia. And to make sure it stayed in the family and in his name as an estate, when my mom passed away, my dad could not inherit any of her assets that he left her. It went straight to us as the children. So that way, if my father was to get remarried, the children would not be excluded. So I'm glad you're emphasizing us doing our due diligence and asking these questions because my father had outside kids as well as my grandfather. And if we don't take the time to ask these questions, it will be a nightmare when they pass along. So I just want to let you know there's another beneficiary succession option that I didn't know existed until my grandfather passed away on my mother's side.
Understood. Does that mean daddy and granddaddy were Rolling Stones? Getting
Yeah.
it? Hey, come on.
Yeah. Yeah.
And
Some of it, some of it was known, some of it was unknown, but it caused a lot of issues. So this is a touchy subject, but we have to talk about it because if something happens, they'll be fighting over the state. It has to go to probate. It's ugly. That's all I'm gonna say.
Yeah.
Now, on question for you, Miguel, on the amount of money, like for like when you go to leave the minor's money, is there a certain amount? Because, like for example, me and Jonathan have 5 kids together. He's got 2 boys. We have one biologically together. We have one legally together, and then we have my daughter. Is there like my 2 oldest kids are his stepkids, and his 2 oldest kids are my stepkids? Is there a certain amount that, like, when we go to leave it, is there a certain amount that we are allotted, or can we just leave them whatever we want each kid?
Yeah, you are allowed to, since you're the policy owner, you can designate the beneficiary. So you have 5 kids. So if you wanted to leave each of them whatever 20% each.
Okay.
Or that one kid, nah, you were bad, you get 10%. All right. Not saying anyone's got a kid like that, but anyways, I love my kids. But good job. Good questions. Okay. Last part of this. Okay. Revocable versus irrevocable. So this is big right here. The policy owner as a can choose to change the beneficiary at any time. That would be called a revocable beneficiary. Let me see. Okay. Policy owner without the consent or knowledge of the beneficiary can change designation. That's what you want to write down for revocable. I don't know about you, but I don't want beneficiaries having any control. Like, let's just say I don't like you one month. Nah, no, you're looking at me kind of weird. And I always tell the husbands, the moment a wife takes that policy out on you, you better sleep with one eye open. Because sometimes
Look, Jonathan already thinks that about the policy we got.
And Jonathan is smart to think that way. You got to be a little bit paranoid. Not saying
That's
y'all
horrible.
somebody, but guess what? All right, so irrevocable allows you to change the beneficiary. This one, irrevocable designation, you cannot change the beneficiary unless you have the beneficiary's written permission. I used to say, Anna, who the heck would give someone that kind of control over the policy? Are you kidding me? Like, I got to get your permission to change it until I learned about it. So let's just say, Anna, you and I are in business together and we have a policy. We're each other's beneficiaries and we're going to name each other as irrevocable beneficiaries. What if we're business partners? And you say, you know what? I don't like you, Miguel. I'm going to go behind your back and change the policy. Well, then that would make sense. That's the money's supposed to go to my family to buy me out. Or let's just say you have a whole life policy and you have some money built up into that policy. And you say, I want to get some of that money out of the policy. Because you have an irrevocable beneficiary, you can't even pull out of that account unless you have the beneficiary's permission, because they're going to get that money if something happened to you. So I can see it actually working to protect someone in the business aspect. But like other than that, relationships, nah. If I don't want you in my life no more, you got to go. Any questions on irrevocable versus revocable?
Miguel, so if somebody has a power of attorney, well,
Plus-
no. Let me go back. That's not the question I want to say. When you was talking about the getting written permission or the revocable one, and say for instance you in a coma, a medically induced coma, and you can't respond, I can see them doing the revocable one. The irrevocable one, I think that would be a power of attorney if that individual can't give written consent.
I don't know. I can give you a real life story that happened
Okay.
4 years ago. So I had a client. We wrote her policy in February of 2020. Yeah, 2020. We wrote her policy and she'd let it lapse every few months and I'd have to reinstate it. And I'm following up with her. And then she gets pregnant. She has an 18-year-old daughter. And she left all the money to the daughter because that was her only kid. She has a baby. Oh no, so she's pregnant. She gets pneumonia and COVID. She gives birth to the baby early and she dies like 2 weeks later. The $250,000 check went all to the 18-year-old daughter, and the son was left with nothing because we did not have the opportunity to change beneficiaries. So this is the important piece of, we couldn't get in there. She was like in a coma. And what if I told you this was actually Jade's cousin? This is actually was a family member to Jade, which kind of family to me too. It all came up. I'm like, I remember being in bed just like, dang, that sucks. And then when I had the check, I went to me, the daughter came to my office and she brought her dad. And let me tell you something. This dad was not in her life. He swoops in and finagles the whole conversation. And where the mom wanted us to invest the money, we don't have the legal authority to say, oh, you have to do this. We deliver the check. The dad takes the entire check because it's manipulation, what he did. And guess what? That within, I think, less than a few months, that money was gone. Yeah, it was a very sad situation. And looking back at it, I wanted to punch this dude in the mouth when in this meeting. But I share that with you. We're on chapter first beginning of this thing. I'm getting excited for this chapter, right? But that was the important piece to me, because when I saw this, is it gets nasty, like you said, as beneficiaries fight over money. You want to, yeah, money gets involved. You get to see the nasty side of people. But let me show you another legality part here. So there's something.
Now,
oh, go ahead.
Quick question on that situation. Is there a way to keep, for example, is there a way to keep the parent from getting the money from the child?
It's the child's money. If they have the influence and they can get it, ain't nothing you can do about it.
Okay.
Now, the proper thing would have done this. If we had to set up a trust and the money went directly to the trust, and we had a trustee, which it wouldn't have been me, but it would have been somebody else. I think in that situation, it was going to get manipulated either way. But this is the important parts about having a will and a trust in place, not just life insurance, right? You got to have the legality part of this behind. But I want to share something with you. The Uniform Simultaneous Death Act. This right here says that, hold on, let me make sure I'm not confusing these two. Okay, yeah, this is it. So this simply says that if a insured and a primary die at the same time, let's just say they're in a car, unfortunately, they're going to assume that the primary insured died first. So the money will go to the contingent beneficiary, not the family of the primary, because it could be two different families, right? So the Uniform Simultaneous Death Act, the what you want to write down here is this. It says that if there's no sufficient evidence that the policy proceeds will be distributed to the will be distributed as if the primary insured died first. I'm sorry, primary beneficiary died first. I want to make sure that I don't overstep that too fast. I'm gonna move a little bit faster because I see us we're getting a little bit behind here. The Common Disaster Clause ensures that if dies. Okay, this is the exact same thing, except that it gives a period of time. So it's 14 to 30 days. So it just adds on to that, but as if the primary passes away within a certain amount of time before the insured, then that'll happen from there. As long as the beneficiary dies within the period of time which the following death is insured, it is still as interpreted as the beneficiary died first. It is the intent to fulfill the wishes of the policy owner and regarding payments to the beneficiaries. You will probably see more of this one, the Uniform Simultaneous Death Act, but they're simultaneous. They coincide together. Okay, let me just pass through.
Miguel, I have a question.
Yes.
If it is the beneficiary that will receive, let's say for example, I have my two daughters a beneficiary in my policy.
Yep.
And they have divided as a 50% each of them. If one of them dies, who is going to go down benefits to?
Then it would go to 100%.
It's going to be 100% to the other one?
Correct. Unless you put a third one on there, Miguel.
Oh, okay.
Not telling you to do that, but if you
No,
again,
no.
no. Okay, so let's talk about premium mode. If you see, I want you to connect these two words together. If you see the word mode, it's describing the frequency of how you pay into the policy. There's only 4 ways to pay into a policy. It's monthly, quarterly, semi-annually, or annually. So just write the word mode, means payment. This is how you're paying into it. Okay, any questions on that? Nope. Okay. If let's see, if the insured dies during a period of time, which payment, okay, so this is something that you need to know, that if God forbid an insured dies during a period of time, so let's just say you pay, your payment is due on the 1st and the primary insured dies on the 10th, the family will get a refund of whatever money was unearned. So it's good. They will prorate a refund of the certain premium back to the family or to the beneficiary. That make sense? That's something we want to know. Okay. Level premium versus flexible premium. This just simply says, again, we talked about this in chapter 2. Level premium simply says that the premium will stay the same throughout the period of the contract. Flexible premium allows the policy owner to increase or decrease their premium throughout the policy period. Again, that was probably your adjustable life, your universal life policies. Those are the ones that are going to allow you to do that. All right, this is an easy one for you to get right. Grace period. Grace period is 30 to 31 days. This just says that if God forbid you missed a payment on your policy, the family is still protected 30 days after that payment is missed. And it is to protect against unintentional lapse. This is actually the definition you want to write down. The purpose of the grace period is to protect the policy owner against unintentional lapse of the policy. And that is 30 to 31 days, a month. I thought about it last night. I don't know if I've ever had anyone pass away during the grace period. I've paid out 9 death claims in my career, and it's crazy when you pay one of those things. This business is real at that point, right? It's I get real. So again, the grace period is the period of time to protect the policy owner against unintentional lapse. All right. All right, move on to the next part. Reinstatement. So reinstatement is a big one. We're going to take very specific notes on this. Reinstatement happens if your policy lapses. Only way a policy will lapse is if you miss payment. Sometimes you miss a payment every once in a while, right? Just life happens. If you miss a payment and the policy lapses after the grace period, or even before the grace period, you can reinstate the policy. Now, there are things that you have to do in order to reinstate a policy. You can, up to 3 years, you can reinstate the policy. So if the policy has been lapsed, up to 3 years, you can reinstate it. Most of the time, you'll probably write a new policy at that point. If it's been lapsed for over a year, you'll generally rewrite the policy. Because if you reinstate it, they're gonna have to pay back all those old premiums they missed. That's a big payment you got to make. So these are the 3 things, if you want to kind of write this in a bullet point, you want to know. In order to reinstate a policy, the insured has to provide evidence of insurability. In most situations, that's going to be just answering the medical questions. Hey, has anything changed in your life? Answer is no, then no. It could require that you have to redo a medical exam if you had to do it the first time. If they require it, you're going to have to do it. That's number one. Number two is the policy owner is required to pay back all premiums plus interest. So if you owe money, you pay back all the premiums plus interest. And the third one is if you had a whole life policy and you took out a loan, you have to repay back all the outstanding loans and the interest. Any questions on that? Nope. All right. Note this, a policy that is surrendered can never be reinstated. So write that one out because that's going to come in a little bit later into the chapter. A policy that has been surrendered can never be reinstated. Okay. So let's talk about incontestability. The incontestability is 2 years. This right here, I'm going to give you the exact statement we want to write. Okay, I'm looking for a simple definition, but okay, let's just write this out. Clause prevents an insurer from denying the claim due to statements, applications after the policy has been enforced for 2 years. I'll give you an example of what this looks like. Is God forbid you write a policy in the first 2 years, every insurance company does this. They look at to make sure that the application that, hey, you said you were a smoker, but you weren't. I'm sorry, you said you weren't a smoker, but you were. They're going to look for any foul play. They're going to look for anything. Did he commit suicide in the first 2 years? Did you die in the act of a felony? Did you die as an act of war? Did you go parachute jumping out of an airplane when you said you weren't going to? There's things like that. So most people would call this like an exclusion. Why would the policy not pay out? In the first 2 years, insurance company is going to do everything in their investigation to look at it. I can tell you that probably half, if not more than half of my, no, it's probably half, if not a third of the policies that I paid out. Some of them died within the first 2 years, and they had to do an investigation for this. This sometimes can prolong the payment to be paid out. Right? So this can sometimes prolong the payment to get paid out. Anything you could do about it? No. It's just they have to go through the investigation. Now, after 2 years and a day, does not matter. You could have lied on your application about, hey, I wasn't a smoker. And if you die, your family's getting the money. Okay. Now, misstatement of age or gender. If you misstate your age, not saying anybody on this call would ever say they're younger than they are or older than they are. But if you say, hey, listen, I'm 45, but you're 47. And God forbid, when you pass away, they're going to look at the death certificate and all that fun stuff. And they're going to say, hold on. This person was actually older. They're going to adjust your death benefit based off of the money that you paid, what it would have bought. Same thing with sex. I love how it's intertwined now, age, gender, sex, stuff, today's world. If you are a male or female, men are more expensive. And guess what? I will state this from the highest sky. They are going to go based off of what you were born as. Not what you claim you are. Not what you identify as. It is what you were born with. Okay. They will always do that. No matter if it's 10 years, 20 years, 1 year. They can always adjust that. Now let's go back to policy loans. Did you know that in a whole life policy, if you build any savings, Misty, if you said, hey, listen, I want $5,000 out of my savings, you have to give them written notice. So you have to give them 30-day notice. And they can hold the policy. They can defer your payment up to 6 months. So if you say, hey, listen, this is my money and I need it now. No, they can say, okay, we'll give it to you, but we're going to give it to you in 4 months. Nothing you can do about it. So if you take out a loan on your policy loans are not subject to income taxes. You want to write that down. Policy loans are not subject to income taxes. Okay. The thing we want to look at right here is called automatic premium loans. What you want to write is right here. Loan prevents unintentional lapse of a policy. That's all you want to write for now. So automatic premium loan is loan that prevents unintentional lapse of a policy. So how does that work? This only applies to whole life insurance. This does not apply to term insurance. Again, Anna, we're going to go back to the example of universal life. You know how you said you could skip a payment, or if you they'll take a payment from your hold on one
Cash
second.
value.
Hold on
They
one second.
defer.
Yeah, hold on one second before we jump in here. They will take the premium from your cash value to pay your premium. And they'll keep doing that until your policy is at 0 and it is a loan. Even though they're just transferring it from one account to the next, they're going to charge you. And I want to make sure that we answer this one part right here. If the loan and interest are not paid or repaid to the insured, the death benefit will be subtracted for whatever you owe. So I want to paint this picture for you. Whole life insurance, and savings combined. This cash value policy is supposed to be your money. You're going to borrow your own money. You're going to pay the insurance company interest on your own money. If you do not pay that money back, they are going to deduct the interest, whatever the loan amount, from your family's benefits. So give you an example. If you had a $100,000 policy and you had a $10,000 loan, they're going to take $10,000 out of your family's death benefit because you didn't pay back your own savings account. Does that sound like a good plan or not? I'm giving you the reality. When you take this exam, you have to take it from the perspective of whole life insurance is good. Although it has too many loopholes, which again I won't get into. But that is how the inside of it works. Okay. Let's talk. Go ahead. Someone about to say something. Oh, okay. I thought I heard somebody. So let's go through exclusions. The 4 exclusions, you don't even need to write these out as far as their whole definitions. It's these in big letters, reasons why your family will not get the money. First one is aviation. Most insurance companies will not cover will cover a fare paying passenger or pilot, someone that is that drives a commercial airlines. But they might exclude non-commercial pilots, or they might charge you extra money because you're a higher risk. So aviation. Second one is hazardous occupations or hobbies. Listen, I'm here in Florida. Whenever I ask my people this, I'll say, hey guys, Do you plan on doing any of these white people activities? Scuba diving, mountain climbing, parachuting, hang gliding, racing any automobiles, snowmobiles, or boats? Why do I call it that way? I like to make my people laugh. And ain't no Mexicans doing that. We already here. We already in the country. We ain't doing it again. No, you get it. All right. So in that scenario, they will not pay out if you say, hey, listen. And the question that we ask on the exam is, I'm sorry, on the application is, in the next 2 years, do you have any plans on doing these? And it goes through a list of things. And most people say no because they don't have any plans, which they're not lying at the time. But in that 2-year period, it could be contestable if, God forbid, something happens. Bucket list. Guess what? And your last name is Gamble for a reason. You gambling with your life. Good luck to that one. All right. Another reason, war or terror clause. So some policies still have these, that if a person dies in the act of a domestic or terrorist attack, their policies will not pay out. I don't know if you guys remember, probably about a decade ago in Orlando, Florida, there was a shooting at a gay club called the Pulse nightclub. There were some people that we knew personally that were there, but there was actually a client of our company that got killed. We paid out the claim. But if you read on the news, it said this was considered a terrorist attack. The moment they label it a terrorist attack, the insurance company, if your policy has it, a war or terror clause, they could have the option of not paying it out. The war or terror clause is not common these days, but I still see it. Meaning, again, for whatever reason. Okay, last thing here. Get on my soapbox. Suicide. Simply this: suicide. If someone commits suicide in the first 2 years, their family will not get the death benefit, but they can get a refund of the premiums that were paid into it. So again, let me rephrase that. Re-emphasize that. If a person passes away due to suicide, the beneficiary is not getting anything if they pass away in the first 2 years, but the beneficiary could get a refund of the premiums paid. I know that was a lot there. Any questions?
So when you say cool, get a refund, that means that it's no always that the person can get the refund.
I can tell you this. I had one client, unfortunately, she offed herself. And I was so young in the business, I don't know if they got a refund. I don't know what happened in that scenario, because the family, we reported it to the company, and I don't know what happened afterwards. I was so new and young, and when that happened, I was like, I could have done better in that situation. I got to do better. And I share my mess ups with you guys to know that, hey, there's been mistakes that we've made, and we won't do those things again. But I was so brand new in the business when that happened. But go ahead, Misty.
My mom literally just helped one of her co-drivers, because she's an OTR truck driver, and my mom just helped him because he couldn't get a hold of his wife, and she just committed suicide, I believe Monday or Tuesday.
Oh, dang.
Yeah.
Oh, that's rough. That is rough. Okay. Let's bring we'll bring it back up, bring the alive. I know it's gonna be a devastating thing. Let's talk about riders. Okay. Disability riders. This right here says that if you become disabled for whatever reason, your family will get payments monthly. These are generally your supplemental policies. These are like your Aflac and companies like that sell these policies. Disability riders, we'll go into more detail about that one. Waiver of premium. So this is what you want to write down with waiver of premium. If the insured is totally disabled for 6 months. I'm going to give you the bullet points. For 6 months, they're totally disabled. After 6 months, their premiums are waived until they can go back to work. There are scenarios the person will never be able to go back to work and their policy's paid for. Now, what describes disability? I had a client probably maybe 3 years ago, yeah. And on every policy, I always offer waiver of premium. It was a couple dollars more. She says, "Can I just do it later?" I'm like, "Of course you can do it later. You think you can always do it later." She ended up getting MS, multiple sclerosis. She's 100% disabled. She can't work. And because she was not able to work, guess what? Her policy lapsed. And now we couldn't even rewrite her policy, because now she has got that illness. I would always encourage you to push for your clients to get determined the waiver of premium. So the other part that I needed to write on here is, once the 6 month has hit, they will reimburse the last 6 months of the payments to the client. So after 6 months, if the person is still disabled, the policy's free, and then they will reimburse the last 6 months of their premiums.
Miguel, when I was working for the state, back in 2014, I had a disability policy. I think it was with Colonial Life. And I thought once, because I had to go out on medical reasons, I couldn't come back to work. So I thought I lost that policy and all the benefits. But I got a letter in the mail from them almost a year and a half later. And when I responded, and I told them what happened, and they got sent the attending physician statement to justify it. They reimbursed me. They paid out my disability policy. It was almost $15,000.
God bless.
So yeah,
Good job.
it does. Yeah, it did. It helped, and it was needed. So I agree.
Good. Love to hear that. All right. So I'm gonna try to fly through these somewhat, because all right, waiver of monthly deductions. I don't even know. I don't even really remember seeing this on tests when I do it. It's pay riders will pay monthly deductions while the insured is disabled. After the 6 month waiting period, policy, the rider only pays monthly deductions and not full premium. Okay, so this one would be this is going to help you pay some of your payments for a year. Okay, that's straightforward. Disability rider, again, this just says that it'll pay a portion of your income or your amount of your policy to you if you monthly, if God forbid you become disabled. Okay, I want to clarify this. Payer benefit covers children, minors, that if their parent or guardian becomes disabled or passes away, the child's policy is waived until they are 21 years old. So payer benefit, write kids next to that, or minors, that if their parent or guardian becomes disabled or they pass away, their policy is paid up until they're 21. In our policies, the company that we write for, that's automatically in our policies. Back to that example of the client that passed away from the children that left the money to the 18-year-old. That child, the 18-year-old and the now 4-year-old, their kids' policy is covered until they're 25. They've got like 10,000 on each of them till they're 25 automatically, because we had a child rider on their policy. Okay. Other insured rider, spouse rider. This is just if you have a spouse. I'm sorry, if the husband, let's call him the primary, and the wife wanted to get a policy together, she would not get her own policy. She would be added on to his policy, which is called a spouse rider. If you have children, they would be known as other insured or known as child riders. Let me give you the special part about a child rider. Child riders are huge. Every policy, if you got a parent, or if you're a parent, you should all have a child rider on your policy. Because if you pay for one child, it covers all of them. See, Misty got 15 kids, right? You pay for one kid, covers all 15 of them things. And I called things, I got 6 of them. I got 6 of them. So now who classifies as a child rider? This is answer your question the other day again, Teresa, from the other day. If they're natural, adopted stepchildren, you can even have your nieces or nephews or your grandkids in there if you take care of them. It can't be because they live across the United States. Oh, I want to cover my grandbabies too. No, they don't. If you don't take care of them, you can't have them. But you pay for one child, it covers them all until they're either what age? 18 to 21. I would encourage you to do this. Most child riders are so cost effective. If you have friends that have kids, get a policy on the parent, add them as a child rider because it'll cover all the kids. And then when they turn 21 or 18, they're able to get their own policy with no evidence of insurability. They don't have to go out there and prove insurability because they're already covered. Family policy, pretty much the same thing I just mentioned. You might want to come back here and read this, but I kind of wrapped that up in one little thing. Okay, here we go. Riders such as accidental death and dismemberment. This one is called AD&D. This is a policy that is either sold as a rider or your bank sell this. If you ever see, oh, my bank gives me $100,000 for like $2 a month. It's called accidental death and dismemberment. And let me show you how not likely this thing is to pay out. So this policy will pay out the face amounts and the result of an accident as defined in the policy. The death must occur within 90 days of such an accident. The benefit will normally do 2 times the amount or 3 times the amount. Now, how does it pay out? Let's go here to the fine print. The dismemberment part is a portion of the rider usually determines the amount of benefits that will be paid out. The full principal amount will usually be paid out for the loss of 2 hands, 2 arms, 2 legs, loss of vision in both eyes. So if you lose a thumb and a pinky, that ain't dismemberment. You ain't getting the money. So what's the likelihood of that actually happening? Not high at all. So that's why you see a lot of these policies out there. And that's why the premium is so cheap. I personally don't, when I see this, I'm like, that's not life insurance. If you die in an accident and you get the money, congratulations, but you better not count on that. Now there is a part in here. Let me just make sure. It says the rider usually expires at 65, no cash value attached to that. Each policy specifies what's considered an accident. So each policy might not even be the same type of accident. You cannot die as a result of any health issues or disability. It cannot be due to self-inflicted injuries or war or hobbies or hazardous activities. I always like to say this. If you're in Jacksonville, the likelihood of this paying out is like you getting into an accident between the intersection of 3rd Street and Blanding Boulevard. Well, we know those streets don't intersect at all, right? That's the likelihood of these things paying out. I'm sure there's somewhere in the world of insurance that there's been a policy that paid out, but that's what I've seen so far. Okay, guaranteed insurability. What you want to write is this. It allows insurers to purchase additional coverage at specified future dates. Right here. You want to write all that out. Essentially, a guaranteed insurability rider allows you to get more coverage either every 3 years or if you get married, have a child without any evidence of insurability. This allows, it's really good for policies because let's just say your income is here and you don't really have a lot of responsibilities, but gradually as your income goes up, your responsibilities go up, your need for insurance goes up. And allows you to do that without going through any medical questions. But I always want to leave this disclaimer. Anytime your coverage goes up, so does your premium. You will not be without paying more money. Any questions on this so far? Okay, I'll give you guys a second. You just let me know when I'm good to move on. Okay. All right, here we go. Return of premium rider. You remember in the term insurance part, I talked about return of premium insurance? Where this is a rider that you can buy on, or again, it's implemented by using term insurance. When a whole life policy, it provides death prior to a given age. Not only is the original face amount payable, but it will also add on whatever premiums you paid into it. As you get to see, it expires at age 60. Remember, when you add return a premium, the insurance company is going to charge you 25 to 50% more for that policy to have that as a rider. Again, return of premium, the easy way to remember it is, hey, if I don't die, they're going to give me a portion of my money back if it's an individual policy. But if you have it on a whole life policy, and you pass away, your beneficiary will get the life insurance plus whatever premiums you paid into it in that example. Let me just, okay. We're almost done with riders. Okay. We're making good traction now. We're kind of caught up. Okay, I'm gonna take a little bit of time right here on this one. Can a spouse or let me read what you wrote here. Unfortunately, probably not. Because that person, that's a question that they ask on the application. And then they would have to be here to sign it. Okay, so accelerated living benefits or long-term care. There are policies that have long-term care benefits, riders, and the policy that when the person gets of age, they need to start getting a portion of that money. But when you start taking benefits, and as far as living benefits, as such as accelerated living benefits or terminal long-term care, it's going to deduct from your face amount. It's going to deduct from the amount of money your family would get. There's not a lot in here that I can really teach you because it's just simply works that way. These are just riders. If you understand what long-term care is, it's meant to cover your family when you get older, kind of cover those expenses. Okay, this one right here is called the cost of living rider. This one addresses inflation by automatically increasing your coverage amount with evidence of insurability. So we have this in our policy that incrementally every year you can increase your coverage by 10% without going through any medical questions. Because can we agree $100,000 today was not, or yeah, $100,000 today ain't gonna be worth $100,000 in 10 years. So that's why you need the cost of living rider to kind of keep your coverage going up. But again, just because your coverage goes up, your premium goes up too. Just need to make a note of that. Again, when you get the chance, come back to chapter 3, and I would encourage you to write this stuff out right here. The last part we're going to cover is called policy options. Teresa, you still writing? I see you looking. Am I good to move on?
You can move on. I'm good.
Okay. So policy options. Let me go through this. All right. So I'm going to give you 3 acronyms tonight. I want you to write it out like this, okay? So non-forfeiture options, I want you to write that, and then I want you to write cash value next to that, or in parentheses. Non-forfeiture options is money that you've built up in your savings account and your policy, that these are things you can do with the money. And their acronym you're going to write out is REC. So REC, not under non-forfeiture option. So the R, I'm going to go a little bit behind. The R is going to stand for reduced paid up insurance. And next to that, you're going to write out this definition. Okay, so you're going to write all this out right here. We're going to take our time on this. I want to make sure that we understand this. So reduced paid up insurance. So you built up, Gia, you built up a savings in this policy, and you say, yo, I'm done paying on this. I don't want to pay this policy no more. You're going to take whatever the cash value is, you're going to take it as a lump sum, and you're going to buy a smaller portion of a policy for whatever that premium will buy. An example, let's just say you had a $100,000 whole life policy and you're like, I'm done paying the $100 a month, but you have 15 grand sitting in your cash value. You're going to take that 15,000 and you're going to buy a smaller death benefit up front, meaning you're going to use that 15 grand to pay the policy off up front. The key word here is this: reduced paid up is you're taking the single premium and you're buying a smaller policy and you're paying it up. That's the easiest way to remember that. Let me know when I'm good to move on to the next one. I know you guys might be, I'm a slow writer, so. Misty, glad to see your man got a shirt on today.
Look, he even cooked dinner and everything tonight.
Thanks for the invite, Jonathan. All right. So I'm going to move on to the next part. So the next, under the REC, so REC, you're going to write extended term. And the word extended term, the word for this, and next to extended term in parentheses, write the word automatic option. Meaning this is what the insurance company is going to automatically do if you don't choose an option. Okay, so what does extended term mean? You're going to take whatever money is in that life insurance policy, in this cash value, and you're going to say, hey, I'm done paying on it. I want to convert whatever this policy is to a term policy for the same face amount for whatever that premium will buy, whatever that cash value will buy. So if you have $100,000 policy again, and you are you're saying, hey, listen, I don't know what to do with this money. You will take that cash value and you'll extend your policy out past 100 years old. So let's just say you had $500 sitting in your policy. Whatever that $500 will buy, you're going to buy that into a term policy of the same amount of coverage that you had. So remember, reduced paid up is you're buying a smaller portion of coverage. Extended term, you're buying the same face amount of your current policy, but you're buying it to extend the policy out.
So
Yep.
Miguel, it's only one policy, not two.
Correct. It's just one policy.
Okay.
You're not buying an extra policy. You're just extending it. Now, let me give you why they call it the automatic option. Every few months, you get a letter from your insurance company. You always get letters in the mail. And what do most people do with the letters from the insurance company? Do you open it or do you just throw it on the table somewhere and all of a sudden you don't know where it went?
Toss it to the side.
So guess what? Insurance companies banking on you doing that. Because they're going to send you a letter. I don't know how many letters they're going to send you or how many emails they're going to send you. But if you don't tell them what to do with it, they can automatically buy you that coverage. Remember, the name of the game is keep the money in-house. Does that make sense? If you understand extended term, that's all you need to know. Okay, now we're going to come to the last one. I want you to write the word cash surrender. And then under, along with cash surrender, just say, take your money and run. In this example, all you're doing is just saying, hey, listen, I don't want the face amount no more. I don't want the coverage. Just give me whatever I have in the policy and I want to cancel it. Or give me whatever cash values in the policy and cancel it. Give me the check. So take the money and run. Now, let me give you the legality part of this. If your cash value has grown, look, give me an example. If you have a policy and the cash value is $12,000 and you've paid $10,000 of premium, there's a $2,000 profit there. Would you agree? You're going to, when you close out that policy, you're going to owe taxes on that $2,000 profit. So the difference is the amount you paid into the premiums and the amount that has grown in the cash value. If you cash out, you're going to owe taxes on that as ordinary income. And you guys remember when I said under the reinstatement part, it cannot be reinstated if you surrender the policy? If you surrender this policy, you cannot reinstate it. So when I said that earlier, we say, hey, write that in bolds. That's what that means. If you cash this policy out and you're like, I'm done, and you can't come back 3 months from now and say, hey, can I get that policy again? No, you canceled it. You got to rewrite a new one. That is all you need to know when it comes to non-forfeiture options. If you know the terminology of this, you're gonna kill the exam. I'm going to go to another acronym that's going to be a little bit more in detail. I want you to go to another sheet, and I want you to write the word dividends. So what is a dividend? So a dividend in insurance is a return of excess premium. So right here, I want you to write, this is the definition of a dividend. Teresa, when you hear the word dividends from an investment standpoint, that means profit to you, right? Well, this is how twisted the insurance companies are. They redefine the word in insurance and they say, hey, we're going to give you dividends, but all they did is they overcharged you. And they're going to give the money back to you and say, hey, we gave you a dividend. There's a company out there that during the Super Bowl, years ago, they did this. I don't know if they do it anymore, but they advertised themselves as, we paid the most dividends out of all insurance companies. And when they did that, I'm like, they literally just said, we overcharge you and we give you your money back. It sounds good in marketing, but when you get down to the fine print, that's what they're saying. A dividend, if it was from an investment standpoint, Anna, would be taxable because it's profit. A dividend in insurance is not taxable and they are not guaranteed. I want you to make sure you know that. Dividends in insurance are not taxable, not guaranteed. So from the standpoint of a dividend, there's a few ways of you're going to get this money and they give you options of what to do with it. We're going to give you the acronym for this. I want you to write the word CRAPO. It's going to be like, just like we'll kind of write it down like this. C-R-A-P-P, so P-P-O, CRAPO. So if you write dividends, it's going to say return of excess premium, not taxable, not guaranteed. And when they give you the money, they give you options of what to do with your money. So the first C, the C in the acronym stands for cash, which simply means, hey, they give you a check and you take the money. In every acronym, you're going to see C always stands for cash. So in this example, Misty, they give you the refund. Okay, give me the cash. I'll take my money back. The R, Anna, stands for reduction of premium. Now, so write reduction of premium, and then next to that, I just want you to write the word reduce next year's premium. That's the definition of it. Reduction of premium means you're going to reduce next year's payment. So in this example, it says if the policy owner usually pays $1,000 a year and the insurer decides to declare a $100 dividend, the policy owner says, hey, listen, I don't need the check. Just count that towards the next year's payment. Pretty straightforward. Reduction of premium stands for, hey, just pay it towards next year's premium. Okay. All right. On the word accumulation at interest, when next to the word accumulation at interest, I want you to write the word temporary option. Forgive me. No, that's not the temporary option. Scratch that. It's in the next acronym. Accumulation at interest. This simply says, because the dividend is not taxable, you can say, hey, listen, hold on to the money, invest the money for me, and then add the benefits onto my death benefit. So they say, hey, listen, just invest the money, Misty, and it just add it to my death benefit. The thing we want to know about accumulation at interest is anytime you earn interest, it is taxable. The government wants their money. Trump wants his money. And I know you guys are big Trump fans, so I'm not going to knock you for that. I'm not, if you're a Biden fan, I ain't going to knock you for that either. I know Mrs. Gamble over here. I see you got, where your MAGA hat at? Normally I'm used to seeing you wearing a MAGA hat.
No, sir, you did not.
Just joking. Chill.
Never.
I'm just messing. Let me not get political around here. I just love the little poke. All right. So, accumulation at interest, right? The next one is paid up addition. Next to paid up addition, I want you to write the word automatic option again. And if I'm going too fast, please let me know. I see you're writing. I don't want to move too fast ahead of you guys. Okay, so paid up addition. Talking about iPhones, please. All right, so the paid up addition option is just like that extended term option. They're going to send you a letter in the mail. Say, hey, listen, we got money for you. If you don't choose what to do with the money, they're going to automatically increase your death benefit with it. They're going to use it as a single premium to increase your death benefit. Because remember, what's the name of the game? Keep the money in-house. They're just going to take that money and buy you more coverage. Nothing wrong with it. It's just they're going to automatically do it. So they're going to automatically increase your death benefit. It's actually not a bad thing. Any questions on this one? Nope. Okay. The last P is called paid up additions. This right here example simply says that if you get a refund of your money, you say, hey, I don't want the money, put it towards my payment and help me pay my policy off early. So if you've ever talked to somebody and they're like, oh yeah, I paid on my policy for so long and now I don't owe anything. It's because they had what are called paid up options. They just simply use the dividend to pay the policy off sooner. I don't know how they do that versus return of premium. Oh, how do you defer? Is paid up option? You're gonna pay the policy off sooner, or you're gonna put it towards next year's payment. I don't know how they differentiate it, but for the sake of the exam, that's all you need to know. It's using paid up option uses the policy owner to pay up the policy early. Okay. Any other questions? All right. Last one is 1 year term. I think that's pretty self-explanatory. They say, hey, listen, here's your dividend. What do you want to do with it? I don't know. Whatever that money will buy, just buy me a 1 year term policy. That's pretty straightforward.
Is this one of those arts?
One of those what?
Annual renewable terms.
No, this has nothing to do with annual renewable term. This is a dividend option of what you would do with that policy.
But is that what it becomes when it says a 1 year term?
No, it has nothing to do with art. It's just a 1 year term policy for whatever your face amount was and that it will buy at that time. Okay. Okay, last one, y'all. This one's a big one. I'm going to spend a little bit of time on this one. I want you to write settlement options. And we have another acronym for us. This last acronym. But if you can learn these definitions and know the acronyms and where they apply, you're going to kill the exam. Okay. This acronym is going to be called CLIFF. CLIFF. And leave a little bit of room while you're writing here because there's things we'll add into this more than just definitions. C stands for cash. You say, hey, listen, a person's passed away or doing the annuity period. Remember how I said earlier in the chapter, I'm going to cover annuity payouts. This is where this comes into place. So let's just say you have a life insurance policy or an annuity and it's matured and you said, hey, listen, how do I want to receive my money? You can do something called lump sum, or if you see the word lump sum or cash payment, write the word lump sum. Because if you have a $300,000 investment, they're just going to give you the whole money and not over time. They're just going to give you the money. Remember how we were talking about the lottery situation? They just give you a lump sum payment. So right here is where you want to leave a little bit of room. Under the word life income, I want you to write, this is the highest amount of money paid out to the recipient. This is like the family gets the most amount of money, either monthly, quarterly, or annually, however they receive the money. This is the highest frequency that the money is paid out. Life income is paid out based off of the life expectancy of that person. Life income it's got its drawbacks. Because it gives you the highest amount of money, the drawback is, let's just say you activated this and you said, I want life income for the rest of my life. And you passed away 5 years into it. Whatever money that was going to get paid out, insurance companies keeping it. Because you chose life income. It was only going to pay out for the life of your life. Does that make sense? The part that we will add to this is life income with period certain. This right here is the best of both worlds, where you can have a 10-year or 15-year period life certain. So let's just say you have a 15-year life certain period and you pass away again in year 5. Your beneficiaries will still receive the money for 10 more years because you had a 15-year life certain period. That makes sense? Can I get a thumb up if that makes sense? You guys good? Okay, good. I just want to make sure because the next one is joint life and survivor, still part of this life income. This simply just guarantees that an income for 2 or more recipients for as long as they live. You will generally, for the sake of the exam, you're going to see life income appear certain more than anything, but you should know what joint life and survivor income joint survivor just means that it will pay out for the life expectancy of one and a couple of the survivors afterwards. Generally, it might be a couple kids of the parents. Okay. Now we're going to go into the I. I is going to stand for interest only. Next to interest only, write the word temporary option. You simply are the recipient and you said, hey, I don't know what I want to do with the money yet. So just invest the money for me and pay me the interest. Anytime you earn interest, you got to pay taxes on it. That's all interest only means. Okay. The last two F's stand for fixed period and fixed amount. Anna, fixed period means this. It's a specified number of years that they're going to get equal amounts of money paid to the recipient. So if you said, hey, I want to get the money for the next 20 years, they're going to divide the payments over the next 20 years until it runs out, until time runs out. And if something happens to where a person passes away in those 20 years, the money will still get paid out to the beneficiaries until that 20 years expires. So one is fixed time. The other one is fixed dollar amounts. So fixed amounts, that says, hey, listen, I have a payout of 300 grand. I want to make sure I get this 300 grand, pay it out to me until the money is exhausted. Okay, and here we go. Those are those three. I don't know why right here it says cash is the automatic option. I don't know why that says that. But from my teachings, life income interest only has been always the automatic option. But for the sake of this, you guys see that. This is what your paper should look like. Just yours just might have the definitions written next to it. If tonight you didn't get all the definitions written out because of the pace we're moving at, come back and rewatch this and make sure you write the definitions out, because you'll see most of this exam is vocabulary. Any questions so far? Okay. So chapter recap. We went through all these definite. I mean, we covered a lot of the exam tonight already. I know a lot of this is definitions. A lot of this can be overwhelming, but proud of y'all for sticking in here. How y'all feel about taking a quiz? Want to take a shot at it? Cool. All right. We'll spend just a few minutes knocking this out. All right. All right. An insured has chosen the joint and 2/3 survivorship settlement option. What does this mean to beneficiaries? Let's see. What are we thinking over here? This is that one I told you you're not going to see a lot of, and guess what? We see it. So my guess is going to be just as good as y'all's on this one. So if we don't know it, we can always just use it. All right, Teresa's guessing B. All right. Let's just go with it for the sake of time. We don't need to spend too much time with it. All right. The answer was C. All right. The surviving beneficiary will receive 2/3 of the benefit when both beneficiaries were alive. When a reduced option is written as joint and 2/3 survivor, the surviving beneficiary will receive 2/3 of what was received when both beneficiaries were alive. Okay. So it knocks it down by 1/3. Okay. Which non-forfeiture options pays the highest amount of insurance protection? So let's do the process of elimination on this one. Which answer can we get rid of?
You can get rid of C.
We can get rid of C. Good job. Okay, so now we're looking at which has the highest amount of protection. We can also get rid of another one in there.
Extended term.
So you're choosing extended term as the option. Now we could get rid of B also
E.
because that's not in the acronym. Now we're 50% chance of getting this thing right. What's the addition of reduced paid up?
Reduced paid up.
Was the smaller amount extended term, higher amount? So good job on that one. Good job. All right. So which settlement option pays throughout the lifetime of two or more beneficiaries?
Joint and survivor.
You got it right. Joint survivor. You see, now since we took a practice exam, we know we're not going to miss that one anymore. All right. Which children's riders attached to a whole life policy are usually issued at what type of insurance?
Term.
Okay. Term. Teresa, you're saying B? No. Child riders are always term riders. So child riders, term insurance policies expiring when the minor reaches a certain age. For the sake of the exam, it will be 18 or 21. Child riders are always term policies. All right, so next one. All of the following statements concerning dividends are true except they are a result of favorable underwriting experience. Okay, so let me start here. When you see the word except, you're looking for the wrong answer. They do that double negative there. So we're looking for the wrong answer.
C.
Okay. So someone said C, and you're absolutely correct because dividends are not guaranteed. See, just by us knowing that little definition, that one little vocabulary, bam, we got it. All right. So the insured named his wife, or the insured had his wife named as the beneficiary of his insurance policy to ensure that his wife had income for life after the insured's death. He chose life income settlement option. The amount of payments will be determined by taking into account all of the following except. Okay, Misty says D. Okay, some people are saying D. Nisha saying D. G is saying A, C. Teresa saying A. Okay, the answer is actually D. And the reason being, like I said, the insured age at death is what I meant to say, right? See what happened. What do I miss here? Golly, I'm over here thinking I got this. The insured's death will not be considered, but the longer life expectancy of the recipient. Let me just kind of reframe where I was thinking here. The beneficiary's life expectancy has nothing to do with the payout, by the way. That's where my mindset when I was reading this. Whoever chose C, I apologize for challenging you. Gee, my bad. I bowed down to the Android user at this one.
I was gonna say that's just that iPhone mindset.
I love it. So the insured's age at death will not be considered, but the longer the life expectancy of the recipient, the lower payments will be. Y'all understand that? Why that is?
I was gonna say like that it doesn't matter at specifically at the age that the person dies, it's what's going forward that's, taken into account.
Well, that's true because when they chose the life settlement option, it doesn't matter the age of the person because they were getting life income for a certain amount of years. And the money was going to stop at that point anyways, unless they had the period certain, which obviously they didn't. So, okay. Which of the following options will be stated in the consideration clause of a life insurance policy? So remember, consideration is the insurance company brings value, the policy owner brings value. And this right here is just asking the definition of consideration. So if we go back into your notes under provisions, you'll have consideration right there. Which of the following information will be stated in the consideration clause of an insurance policy?
Will it be A?
Conditions for insurability? Could be.
Mhm.
It could be. I'm trying not to stand on my high horse because I last time I thought I said on my chest, I was wrong.
B.
Someone said, Gia, I think you just said, Nisha, you said C. Gia said A. Jamal, I don't know what you just said.
B.
B. A. Mrs. Suba, where you at? Come on, I know you passed it on Monday. You should know this more than me. You probably like, she just happy to be here. All right, where are we going? A lot of people choosing A. I'm actually leaning towards B, but my brain might be off. It was B, which leads us to a principle. When you're passing your exam, go with your gut and do not change your answer. One of the biggest things people fail on this exam is because they double second guess themselves. God's given us this intuition.
I definitely just second guessed myself.
Did you really?
Because I was sitting here going back and forth with myself, like, no, I think it's B. No, maybe C. I was definitely second guessing myself with this one.
The reason I was going B is because it talked about the amount of money that was being paid, which would have been from the insurer, from the
Right.
policy
And
owner.
it's like the insurer's paying and the insurance company's covering. So I'm like, okay. So if they're gonna pay, how much are they gonna pay?
Yeah, and the question was simple. Which of the following is stated in the consideration clause? It's in the definition. We just
You
said,
see, I read that question wrong. See,
so again, Gia, thank you for saying that. Another mistake that people read, and we all do it, read the question twice out loud so you understand the question before you even look at the answers. Get into a habit of doing that so we are not thinking the question's asking one thing when it says another. All right, which is true about a spouse rider? The rider usually is a level term insurance. The coverage is allowed up to age 75. Coverage is allowed for an unlimited time. The rider is decreasing term. Based off of our studying, just kind of think about the comments and stuff we went through. Remember, the spouse rider is husband is primary, spouse is an add-on. And children are an add-on. And children riders are what type of policy? So the spouse is going to be there we go. I think you guys get where I'm going.
It's A.
Yep. The spouse rider allows the spouse to add coverage. It is available for a limited time only. Sounds like a sale. Expiring at 65. A spouse rider, just like any other insured, is usually a level term insurance policy. Okay. All right. Using class designation for beneficiaries. So we talked about this. earlier. Using class designation is not naming beneficiaries, naming an estate as beneficiary, naming beneficiaries as a group, or naming each beneficiary by name.
C.
I would go with C2. You guys feel good about that one?
Mhm.
Because it's good. All right. Class designations are used when an insured chooses to distribute benefits among the living beneficiaries and their heirs without naming in each individual, such as all my children. Wasn't that a show, All My Children? And guess what? I got a bunch of children. So all of them things.
No, it was a show, Married with Children.
Married with Children, All My
No,
Children.
no, it is a story show called All My Children. My mother watched it to death. It was the story, daytime soap opera.
Hey, there's a family. That was the story of your family, your daddy life too. All his children out there.
Yeah, sure. I remember now.
Yeah.
You're about a dozen, Miguel.
Listen, I love that we can joke around and have fun. Come on, we don't take ourselves too serious, right? All right.
Already answered.
An insured pays annual premium to his insurer, and in return, the insurer promises to pay the benefit and according to which terms of the contract. This is called.
C.
Someone said A. We
Mm.
haven't seen utmost good faith yet. If you haven't seen that terminology, don't go with it. I promise you, utmost good faith is actually in here, but it's not on this. Anyway, go with what we studied. Consideration. So consideration is valued offered by the insured to the insurer and vice versa. The insured makes accurate statements in the application and remits premium payments. In exchange, the insurer provides benefits as stipulated in the contract. Okay. All right, which is true about cash surrender? So let's go back to our REC. What do we know about cash surrender? Is the policy remains active for some time after the policy holder opts out. Funds exceeding the premiums are taxable as ordinary income. After cash surrender, the insured is covered for a grace period of 1 month. The policyholder receives the original value of the cash value.
Ooh. B.
Okay, someone said B.
Mm.
I don't know if you guys can hear that Jeopardy music in the background, but people were saying B. I would tell you the answer is definitely B. Now, let me share with you why all the other answers. Nisha, stop second guessing yourself. I see it.
I was about to say I was second guessing myself, but here's the thing that really caught my eye to the answer because it was based off with income. That's the key word that had me like, but I know it had to deal with income. But I'm like, maybe it's the grace period. That's what I was going back and forth with myself about.
No. So go back and re-listen to this chapter tonight, and I gave you all the key words that you can listen to.
Gotcha.
Funds exceeding the premiums. Remember, if they pay 10,000 and their cash value was 12, they're going to owe money on the exceeding premiums paid, which would be considered income.
Gotcha.
Okay. All right, so we're almost done here, y'all. 3 questions left. Which of the following is true about non-forfeiture options? They are optional provisions. Policyholders do not have the authority to decide how to exercise this. A table showing non-forfeiture values for the next 10 years must be included in the policy, and they are required by state to be included in the policy. Which of the following is true? I personally didn't go over this tonight, so we're going to learn this one together.
Mhm.
A.
They are optional provisions. Yeah, that could be right. Anyone have a better guess or another guess? Nisha,
I don't know. I'm looking at D.
Okay, you're looking at D. The state are required. I don't think the state would require anything.
No,
I think we're at I don't think that the state would require anything like that.
maybe B.
B, policy owners do not have the right to decide. No, the policy owners have
No.
all the rights.
But that would right. Yeah, either C or A.
So
I'm going with A because there's an automatic.
Hmm.
let's see what happens. See,
Oh.
the first time Nisha was right, we second guessed her. God, what are we doing here? Okay. Non-forfeiture values are required by state law to be included in the policy and cannot be altered by the policy owner. The table showing non-forfeiture values.
Yay.
Hey, we still
Good
learning.
job.
15 years in deep, I'm still learning this thing.
Just
Hey, listen, I'm pretty sure they slipped that in there before I looked at this. All right.
Every time we get a new administration, they change the laws, so they have to change this test. So that might be why there's some issues, iPhone user.
Hey, there ain't no daggum. All right. Which of the following is true about class designations? It determines the succession of beneficiaries. It is not allowed. Beneficiaries are not identified by name, or beneficiaries must be a part of the insured's immediate family. True. Which one is true?
C.
C. Okay. Beneficiaries are not named. Well, so class designations are
Groups.
no. Class designations is your
Groups.
primary contingent. That's what that is.
No, the class designations are the groups, like my children. We just talked about that.
I'm not going to second guess you tonight. Maybe I'm tired.
We just talked about that 3
I'm about to say,
questions.
wasn't it just dealing with the class as the definition
Exactly.
of
Yeah, I
multifamily?
believe in that. You believe in
We just said my children. We just
Yeah.
had this whole
I believe in
conversation.
you. Listen, you stand on that. I'm gonna follow you. Okay. But if you're wrong, I was wrong. I knew I was right.
There you go.
See, second guess myself. See, Nisha was right. I knew I was right. But let's talk about it anyways, guys. Okay. Class designated beneficiary is named by, such as my children. You were right there. This can be vague if the insured has been married more than once, or has adopted, or illegitimate whatever children. Many insurers encourage the insured to name each child specifically and name or state a percentage of the benefits that are to be received.
I think that need to be the answer with all the drama that be going on with immediate and illegitimate children.
Listen, the test, we ain't gonna worry about that. The test ain't gonna ask about that.
I know.
Listen, just because you be running for office don't mean we know we friggin'. All right, so which of the following is true about the premium of the children's rider and a life policy? It increases when a newborn is added to the policy. It decreases when an adopted child is added. It remains the same no matter how many children are added, and it decreases when the child reaches the age of 21.
C, final answer, Alex.
C.
Yes, C is the answer. Good job. I promise to not hold y'all up, man. We're going a little bit longer, but I'm okay with it. Okay. What happens when a policy is surrendered for its cash value?
C.
It's C.
The answer is
C.
C. Cash
C.
out, you run. It cannot be reinstated. You take the money and leave. Look at y'all moms. Y'all got all these newborn babies over here, and y'all ain't making no excuses. Y'all showing up and learning. I'm proud of y'all. You're proud of yourself, right? Come on. All right. Once the cash surrender value is selected, the coverage is terminated and cannot be reinstated. What do we get? We got a 66. So it's all right. We are all learning this together. I mean, I know most of it, but I got to refresh my brain sometimes myself. But as you see, terminology is big. Repetition is the mother of all skill. Repetition, mother of learning. We have to do this so many times, over and over again. But proud of y'all for being on here tonight. Tomorrow we'll go through chapter 4. Chapter 4 is going to be, I'll have to pass this exam.
Excuse me.
On to chapter 4. What is chapter 4? Where's my home screen? We will cover chapter 4 tomorrow. I can't even get back to my home screen. Okay. Oh, retirement income. Okay. Yeah, we'll talk about retirement stuff tomorrow. It's actually pretty. Retirement income is actually a lot more exciting than this one. Anybody feel like, golly, how much is this? Am I going to pass this exam? Y'all feel overwhelmed? Or y'all like, I got this. I'm getting it.
I'm a
Do you
little
have- how
overwhelmed
many
because today
classes
makes
do
it
you
a
guys
year that I
have
just
in
had brain
Florida?
surgery.
New York has 9.
You said what?
You have
Today makes it a year that I just had brain
classes
surgery.
in Florida. New York has 9.
Yeah. Yeah.
Wait, Nisha, you said what now?
Today
all
makes it a
time.
year that I just had brain surgery. So I'm a little overwhelmed with certain things. Like I had to watch the videos, go back, read, watch it again, just to make sure. But I'm on point. I'm not gonna let that stop me. Like I said, I had epilepsy, so I've had a seizure for 15 years. So this is like my first, full on go with everything, and I'm so excited. Honestly, it's a little overwhelming, but I'm very excited. I'm very excited.
I love it. I love it. I can tell you this, y'all. I recruited my grandparents to work with me back in 2011, and my grandmother took this exam, I think probably 9 times because she just had a hard time remembering things. But my first death claim came from recruiting my grandparents that recruited a young guy, and we went to sit down with his grandmother. Her policy canceled just a few months later. It was not till 4 years later that I rewrote her policy, and less than a year later, she passed.
Oh, wow.
So remember this. You're getting this license not just for you to earn income, but to change a family's life.
Mhm.
We know people that's in our lives right now, they're going to pass away. I think God's got this plan for everybody. I don't think as you write an insurance policy, it puts some juju on somebody. I just think we're doing the responsibility thing to get the license. So when you're studying, it's not about you. It's about you to get the license, but it is about us to go get the job done, pass this exam for our life, for our families, create the legacy for your clients, and to do the right thing.
Yeah.
All right, y'all with me on this?
Yeah, I've literally had 2 people that
Go ahead, Misty.
I've literally had 2 people that I've tried getting to sit down with me and do our Zoom calls, and I tried getting them to sit down, and they literally passed away like a month apart from each other.
Mhm.
I decided to take the course because my best friend just passed away in December. And I had to go and help out, figure out, how to plan for his service, pricing wise and everything else. That honestly opened my eyes, to a lot as far as, covering life insurance and, how much it really is important to have and how many people are not educated on it at all. So that's why I really am like, you know what, this is where I need to be.
Correct. So proud of y'all for being here. We'll be here tomorrow night, Thursday. And interesting, the crowd keeps getting. I said I was gonna get like this. We started here. Do. Now again, I messaged you about life happens. People sometimes can't show up because life happens. Just rewatch the reruns and get back after it tomorrow. But we'll be again here live tomorrow, 8 o'clock Eastern Standard Time.
All right.